Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Are you ready to get started? Let's go.
Welcome, everyone, to another edition of the SHP Retirement Roadmap podcast. Today, we got myself, Derek Gregoire, joined by my business partner, Matthew Peck, and we have the legendary Peter Roache, CPA, who a lot of our clients know. And if you're not a client, you got to get to know Peter. Welcome to the show, my friend.
Thank you, Derek. And we should apologize for everyone. That's CPA Monday morning.
I know. Well, they won't always hear it on a Monday morning. We'll make sure this is on a Friday.
Yeah, no, it's usually Saturday nights. When people will listen to our podcast, that's what they do on a Saturday night.
They order food.
Yep.
They sit with their family and they put the podcast on.
Yeah, they put the fire going. Everyone just gathers around, the whole
sports,
family.
No sports, no movies, just the SHP podcast.
We bring people together.
So to share how much of a legend Peter is in our neck of the woods, do you know what I did this morning? I thought it'd be a good idea because he's done so much work for our clients and our team. Every time there's one-off tax questions, we email Peter. Peter emails us in like 5 seconds later. If it's a bad day, it's like, Peter, it's been 2 minutes. Let's go here. But we had a bunch of our employees, a full house in the conference room. And you walked in and got a standing ovation, huh?
Yeah, definitely the most embarrassed I've been in a long time.
The sweat's still coming down. But yeah, our team really appreciates so much, and our clients do. There's only good reviews across the board. So going fast back, tracking back to, we started the firm almost over 21 years ago. And what we always wanted to do was to build something that was comprehensive, that looked at all areas of retirement planning. And we found early on in our career, most of the planning was all around like this person, every time we talked about financial advising, it was stocks, bonds, mutual funds, which that's a huge part about what we do here. We have 2 CFAs and Matt runs a whole investment committee, and it's a huge part of what we do for the clients that we serve. However, and we've said it for years, if that's all you have is this pile of money with investments and there's nothing around, where to draw from, income planning, legacy planning, estate planning, healthcare planning, and what we're talking about today, tax planning, you have like a quarter of a plan, not even, you know what I mean? And so what we've worked with Peter on, we do a lot internally, and then Peter and his team at Donnell & Orchid Patch Installed.
You got it.
Got it? All right.
There it is. Nailed it, Derek. I was wondering about this, if you would be able to do it. You nailed it.
So for years, Peter's a partner there. We said we got to knock out one of the names and get Roach in there, and he's too humble to take that approach. So, anyways, we do that partnering because tax planning inside retirement, there's so many facets to it around, and just to tease a few of them, you have tax loss harvesting, you have when to rebalance a non-qualified portfolio based on gains, you have inheritance step up in basis, you have Roth conversions, you have when to do Roth conversions and what's appropriate and what year, and then you have tax laws changing. So do we get ahead of them? If you think about our clients, Matt, doing this for 21 years, we probably should know this number. I'd say 70% of the assets that we have are retirement assets that we manage for our clients. Mm-hmm. And for everyone that knows, you have these retirement assets and you have never been taxed on those dollars unless if it's an IRA, and every dollar that comes out to you or your next generation is taxed at your highest bracket that you're in. And a lot of people don't even think about that. And so we're going to get into a lot of these topics today. Another thing a lot of people are not familiar with is required minimum distributions, or specifically inherited required minimum distributions and the laws that are changing around there. So, Matt, I've teased a bunch of points. Before I get started, Peter, anything you wanted to talk about that you thought was important right now?
Yeah, I guess probably one of the bigger questions that I've been getting over the last couple of years related to you guys has been along the lines of IRMAA. Yep. So people, paying attention to the Medicare premiums that they're paying every month. And again, that just goes back to the full planning, looking at the whole picture and not just one piece, because you can do anything if you're only looking at a quarter of it and accomplish what that quarter goal was, but if you're not looking at the whole picture, then you're going to be surprised by what else comes down the pipe.
Well, there's so many.
And just so, I'm sorry to interrupt, Derek, just so all of our listeners know, IRMAA is income in respect to the Medicare applicant. Long story short, it's the penalty that applies to your Medicare premium based on your income. And kind of to connect some dots, I mean, to Derek's point about everyone that's entering retirement, they think like, my taxes will most likely go down because I'm not working anymore. However, if all of their assets are in 401k, all that pre-tax dollars, suddenly their income could be equal, if not more, because all of those monies are taxed at your income level, which then impact Medicare. So if your income's at a certain level, then suddenly your Medicare premiums go up due to IRMAA. So it's all connected.
So Matt, I think someone came in, someone on that's working with our team, my team specifically with Laura and Natalia. They came in and they have a series of IRAs, 401ks from previous employers, and they're finally getting to the point where they're getting ready to retire. I mean, they've been in, basically, long story short, I don't know if they came from the podcast or TV or radio, wherever they came from, they're like, right now we're making $200,000 a year, which is a good salary for them, but they had all this money in 401k. And so when we forecast it out, they're like, I think she's late 50s, he's early 60s. We forecast it out. It's like, all right, yeah, they said we should be in a much lower tax bracket in retirement. Well, by the time, they might be for a period of time, but by the time RMDs kick in, where you're forced to take money out of your IRAs, they're going to be at like $370,000 of income. And like, what are you talking about? We only get Social Security and a pen. I'm like, no, when you add your forecasted RMDs, and then when you show people what the impact it is, not only tax-wise, not only leaving money to the next generation, but then you look at IRMAA and the Medicare premiums now. They thought they were going to be $160 a month each, or $170 now. It's $400 or $500 a month each, and the whole goal of it is, hey, we have some planning to do. We have a gap of time where we can do some planning with the goal of doing some Roth conversions within tax brackets, but also down the road, not only will your tax bracket be less, but hopefully your Medicare premiums will be less. So just to close a loop there, you can see if someone's not looking at your entire picture. How do you know to me, I'm always confused. Like when our clients look at a portal, they see their goals, their income, their assets, their tax status. And when we make decisions, it's all based on those goals. And if you don't know what you have and what the future ramifications are, and you just saved a bunch of money, then you have no idea how to plan. And that's why if you look at the 5 worlds, income, investments, taxes, healthcare, and estate planning, you can almost argue that what we're talking about when it comes to when to do Roth conversions, how to proceed with IRA dollars, it almost affects at least 4, if not all 5 of those areas, because from an investment standpoint, those monies have to be invested somewhere. If you're pulling money out, they might want that might be one of your more conservative assets, so you're not pulling at a downturn because the government requires you to take money out. Your income is affected because you're pulling that out to hit your income. Your taxes are affected because based on how much you take out, you pay taxes. Your healthcare could be affected because your premiums for Medicare could go up or down based on what you're taking out. And then your estate plan and legacy could be affected because if you leave money in an IRA format, they have to pull that out in 10 years at a high tax bracket. If it's left in a tax-free format, they can avoid touching it for 10 years, get 10 years of tax-free growth, and then pull it out. So that was a lot of information. But you can see just this type of plan, that's 5 different, that's affected by all the different areas of a real financial plan. But when you hone in, that's just a RMD. Well, no, there's so much more to it than that. So I don't know if I'm asking a question, but I guess, do you see like, in the general, working over the years, do you see a lot of like clients that maybe they've had financial planners for a while, but they're not really looking at all these areas and just, they have a portfolio, but not a plan?
Yeah, I think that's probably, from what I've seen of people, that is probably the predominant relationship, I would say, is that it is just one aspect and not the entire picture, which it's like we just said, it is the entire picture that's important, not just that one part.
Exactly.
And I was asking, what would you say is the most common question you get? Let's say from retirees, people that are 55 and older. I know it's a broad question, but is there something that you see consistently? People are always asking this same question, no matter how many times you've answered it.
Well, I would say the funniest question I get is, I'm 80. I don't have to pay income taxes anymore, right? and no, even my wife's grandmother is 103, and she still has to file income taxes. So
when you retire, they don't just Uncle Sam doesn't leave you alone.
Yeah, they don't just say, "Why don't you sit in the corner?" And
you're okay.
You're good. We've taxed you enough during your lifetime. We're all set.
So the current rules for, let's look at IRAs is one of the biggest things. So IRAs, we'll break it down into regular, traditional IRAs, 401k dollars, and then we'll look at inherited IRAs when you inherit money from a parent or whatever it is from an IRA. So for RMDs, or required minimum distributions, are basically an age, which used to be for the first several years of our career, Matt, 15 years or so at least, was 70 and a half. So it said, all right, whatever you have in 401ks, IRAs, SEP IRAs, simple IRAs, 403bs, any money that's pre-tax. You get the tax benefits when you're working. Now you got to pay the piper. So at 70 and a half, in every year forward, you have to take out a certain amount, right? So then it went to like 72, then to 73. Right now it's 73, but for some people listening, it could be 75. Is that right?
Right. Simplification always in the government's eyes. Let's make things easier. So it's been arranged now between 72 and 75. For most people, though, yeah, it would be now 75.
Is there 72 right now? Or 73?
So I guess if it were 72, that would have meant you started last year, so you're now 73. So
okay, but right now, if someone hasn't had to take any, the starting age would be the minimum age is 73.
Yeah,
and then there's a certain cutoff of when you're born, where the younger you are, it's a better chance at 75.
Right. I think for most people now, I think if you're under 60, it's going to be 75.
Okay, so that's the rule. So basically, think of if you're listening and you have 401ks, IRA dollars. Number one, what's it worth today? And number two, what's it going to be worth at 75?
Right.
So, or 73. And if you think of those numbers and you do some math, then you take, let's say it's roughly 4% and up that you have to pull out of it. That's all added to your top bracket, right? All that income.
So whatever I guess the easy way to explain it, if you had no other income, just your Social Security and your RMD, the first thing it's going to do is it's going to make your Social Security taxable. So 85% of your Social Security is going to be subject to tax. And then just whatever the rest of your RMD is, it's going through the tax brackets. So starting at the 10 and going up to the 37, yeah.
And so, all right, so for those, that's for RMDs. And then, so let's say this is another confusing area. So a lot of folks, we have clients all the time, they're inheriting IRAs or 401ks from their parents or whoever. And so I guess, can you explain, like everyone knows, okay, well, I have to get this out in 10 years. So for a pre-tax IRA 401k that's never been taxed, if, let's say you inherited money from your parents, Peter, and you have $500,000 that you inherited in an IRA. So what are the rules around what has to come out, how much, and when? So
and again, to make things government easy, they convoluted the inherited IRA rules so that if it's a spouse that inherits it, they're fine. They can take the IRA and roll it into their own and treat it as their own. But for any children, now you've got the issue, assuming that the person was in the RMD range, they were taking distributions out. The child then has to take that money out over 10 years. 10 years from the date that the person passed. So we've had some transitional rules since 2020, 2021 that have now been solidified so that, just to use an example, if the person passed away in 2022, you have until 2032 to take the rest of the money out, but you really have to take distributions out over 25 through 31. Every year. And then the money...
Does it have to be equal?
Doesn't have to be equal. It has to be at least what the RMD would have been.
Yep.
But then you get into, do I need to take more today just to utilize tax brackets? Do I need to take less today to utilize tax brackets?
So there's tax planning around that.
Tax planning all around that, because especially now we know what the tax rates are going to be in 2025. We don't know what they're going to be after 25 yet, and we certainly don't know what they're going to be in 2032.
So if I understand you correctly, Peter, so client inherits money from an IRA from their parent who's of our RMD age. They now have 10 years to withdraw that money, right?
To empty the account.
To empty it out. they have to take out the bare minimum for sure per year, but they can take out more than that if they want to. However, if they only take out the bare minimum, if an advisor or if they're unaware is saying like, oh, just take out the RMD, then that 10th year they're going to have a massive tax hit. Is that right?
Right. So rather than using today's brackets, if you were taking the minimum amount out and you're still paying at the 22 beginning of the 24% bracket, conceivably, and assuming in 32 the rates were the same, you're probably looking at a majority of the fund, the IRA, being taxed at 37% in 32 as opposed to 24% now.
Yeah, and kind of smoothing it out over.
Yeah, smooth it out over the time rather than take it all in 32 and lose more of it.
Or there's some instances too where, I have clients that are still working and they're still in their 50s, but they're going to retire in 5 years. Sometimes the strategy there is take the minimum for 5 years, and then when your income's lower, then load up the following 5 years.
Right.
So there's planning. It sounds so cliche as I say it, but everyone's situation's unique. Yeah. But it really is. And every plan's going to be a little bit different. But I guess if someone's not in there, let's say someone passes away at 70 and they leave assets to their kids, what's the difference in rules at that point?
So with 70,
they haven't started taking their minimum distribution.
They hadn't taken the distributions. And I will admit, because this rule is somewhat new. I keep looking it up every time that it comes up.
There's no clear direction.
There's you have to take, as I recall, you would take.
I don't think I've ever stumped Peter in my life.
Yeah, right. Absolutely.
This is gold.
If I remember right now, if you hadn't taken distributions, you inherited the IRA, you don't have to take distributions within the 10 years. It has to be drained by the 10th. But again, even
in that scenario,
you would want to space it out because there's no way it's going to cost you less to hold off for the 10 years.
Yep.
So, and hopefully this next question will be more stable ground, but what about Roth IRAs?
That's where I was going.
Yeah, so walk us through the rules of a normal, someone inherits a Roth IRA. What are the 10-year rules that apply to Roth IRAs?
So right now with the Roth, because there's no required minimum distribution, you're back to that rule that you hadn't taken.
10 years.
So anytime within the 10, it just has to be taken out within the 10th year.
Let me pause there for a second because I think I'm always floored. And it doesn't, obviously, we've been doing this for 20-something years, so we have a lot of amazing clients. But I'm floored where people try to be cheap and not hire an advisor when it comes to around this stuff. Because two things, if you have I always think especially if you're married, right? And again, this is touting what we do, so it could be, but it's not just us, any firm. If you are married and one spouse knows everything about financial planning, it's not just about knowing stocks and bonds. First of all, it's knowing stocks and bonds, it's knowing IRMAA, it's knowing tax codes, it's knowing income distributions, it's knowing RMDs. It's like the whole gamut. Like you have to study. If you want to waste your retirement and not waste it, I shouldn't say that, but if you want to sit around every day studying charts, graphs, Congress changes, tax laws, IRMAA, then that's all. You don't need an advisor. However, if your wife or husband is not doing that, you need to make sure that they're not thrown to the wolves if something happens to you and they don't know what to do. So first off, I always say, if you look at the value of true planning, it should add, a Vanguard study said it adds 3% in value. Mm-hmm. And so if you look at it, our average fee, let's say, comes out to 0.7, 0.8% a year, right? Less than 1% on average. So I always think, if you think of that planning, think of this one move. I was talking to a client the other day, and they had a scenario where we did some Roth conversions. And they were like, this doesn't make sense. I can't see paying taxes now. We did the long-term projections. Let's say you're in your 60s right now, you have money you're gonna leave behind to your kids, and let's say you do some Roth conversions and you start taking money from IRA, moving it to Roth. Now the downside is when you do that, you owe taxes. However, if we do it smartly within tax brackets, number one, Matt has always said this, you said this, Peter, we have a known. We know where tax brackets are now, so we can plan as opposed to guessing where the taxes are going to be down the road. So we do some planning. Let's just use a scenario. Let's say we get $500,000 to Roth over the next 5 years. Let's say that client lives to be 85, 90, and that value is $1.3 million, right? Because they didn't need that money. Now again, if that was left in a pre-tax IRA, that your children who are inheriting it, probably in their good earning years. If
Right.
you're 80, 85, they're probably 50 to 60, probably making good money. They're forced to take that money, add it to their income, and pay taxes during that 10 years. If it's in a Roth, let's say you pass away at 85 and they're 55, they can wait 10 years, grow that 1.3 million tax-free up until the 9th year, 364th day, and we'll say, all right, Joe and Mary, whatever the name is, we're going to send you a check, all tax-free. So the plan, like, obviously I geek out a little bit about it, but like the value of a simple plan like that in today's, like, the way Congress is and the way the laws are, isn't that like a no-brainer if it's done properly?
Right. I mean, and using that example, so 60 to when they're 95, so a 35-year period, the amount of growth that then goes to the next generation tax-free.
It's staggering. Yeah, it's staggering. So it's just the important, and this is why we're always, our clients, the neat part about our clients, a lot of times they work with a similar attorney, they work with you as a CPA firm, and your awesome team over there. And what's awesome is, like, during the years, Matt, as we know, Peter reaches out, hey, I need, Sue and Frank's return, or suing their 1099s. We didn't get them yet. So a lot of times us communicating with Peter saves our clients just knowing, okay, I'm going to go enjoy Florida. They got it taken care of. They're going to let me know what we have to do, but it's kind of one team. We're two companies, but one team.
Well, it certainly makes like tax season a lot less stressful for really everyone, right? You think it's less stressful for the client because, as you were saying, Derek, they're down in Florida, and then I'm assuming, hopefully, Peter, you have to tell us if I'm wrong. It makes it less stressful for you because you're not having to track down the client for this information. You can reach out to the advisor who can supply all the necessary documents, at least on the custodian side.
Right. It does make things a lot easier on us because I just ask the question, who are you working with at SHP? and then I send the email over and say, when the 1099s are ready, just shoot them over. And I think it's easy on everybody.
Well, and sorry, one other point I was going to make, and kind of Derek it went back to what you were mentioning about making sure you have a team. I mean, there's that old saying, I think it was Franklin, death and taxes. I mean, this is saying that the most the things that are certain in life are death and taxes, right? I mean, it's been around for whatever 400 years. So if you don't have a plan and someone that's managing both of those and coordinating how they have an impact on you, both you, your family, your retirement, your lifestyle, all of that, I mean, again, that's just a fundamental issue that you need to tackle and manage. And if you are not managing that, it's an opportunity wasted.
Yeah. And if you want to do it yourself, like I said, I couldn't do it myself with my clients, and this is what I do for a living. We have, like I always say, I have Matt and his team running the portfolio. We have a planning team helping on, like, making decisions around long-term planning, income goals, cash flow, where's this coming from? We have you helping us with certain tax planning decisions. So it's like, I couldn't do it by myself. I can't imagine being a retiree trying to learn all these different areas. And if you can do it, God bless you. Do it yourself and you love it. Make sure your spouse is taken care of if something were to happen, because they might not be as good as you at all those areas. You know what I mean? So as we pivot, that's awesome information. I think just tax planning, Roth conversions, RMDs, inherited IRAs, inheriting Roth IRAs, all important topics. Any other, so if I'm a retiree, pre-retiree, anything else that you would say I need to get ready for, or other things when you start thinking about in our planning process around taxes?
I think the biggest thing, besides pulling away from the IRA side of it, is probably more just keeping an eye on where your income's coming from. Is it interest? Is it dividends? Are they qualified dividends? Where am I on realized gains and losses during the year?
Yep.
And is there a planning opportunity there when we get further on during the year? Tax loss harvesting to offset the gains. I know some people do get hung up on, I like whatever XYZ stock, and I don't really want to sell it, but you lost 90%, and
well, that's we always say it's amazing. Like, if we go back to 2022, we did some of the most amazing long-term planning during, like, in terms of, like, what's the making. Making
if God gives you lemons, you make lemonade.
Yeah, there it is. So you knew where I was going. But, like, during that time frame, a few things that we did from a planning standpoint, it's like, hey, we talked to our clients. No one likes that the market's down. No one likes seeing it, but it happens. We've been through it since we started the company in 2003. We've seen plenty of volatility. That was, even 2003 had some volatility. We saw 2008. We saw, I think it was like a few years during 2008 to 2018. It was not bad. It was actually pretty steady, but a few years. 2022, bang, interest rates went up. The bonds got crushed, stocks got crushed. It was a bad year for everyone in terms of being in the market. But it's like, okay, let's look at this scenario. First off, we told our clients we're probably more conservative and hedged than a lot of other firms, so their losses weren't as bad, but they still saw losses. So what can we do? Let's take advantage of what we can do. One, we can do some tax loss harvesting and take losses that we can utilize either for that year or for future years, which we can take a deduction of $3,000, carry over the rest.
Right.
That was number one. Number two, we did a lot of Roth conversions because like, okay, if let's take a situation where if your IRA dollars are down, well, shares of the Standard & Poor's or whatever shares you own are probably down. So if we do a conversion within proper tax brackets and move those same shares to a Roth, pay the taxes, would you rather have the recovery occur tax-free or an account that's all taxable?
Right.
So even like during down years, I remember clients years ago would be like, hey, do you still make money when the market's down, when we're losing money? And I'm like, actually, we should be making double, but yes, we're only making normal. Because that's when it's amazing. There's so much planning around those times. But I think that's when we have a planning focused centric firm, you always look for opportunities. And so I always go back to the same image of like, maybe it's because I'm a type 1 and a little nuts and OCD, but if I'm on a beach somewhere retired, I don't want to wonder if I'm missing an I that's being dotted or T being crossed. I want someone that's looking at all these opportunities for me so I can go, what's our tagline, Matt? You can spend more time living and dreaming than wondering and worrying.
Yeah, exactly. Wondering and worrying.
So I think Matt does too. We kind of nerd out over the planning because there's so much to be done with a good financial plan beyond just, okay, let's buy Exxon and sell Mobil or whatever. That's the same stock, but
yeah, but I'll say,
make sure you caught me on that.
But Peter, if you don't mind, explain a little bit about tax loss harvesting. How does that work? Why is it such an effective tool?
So if you, most of the time we don't talk about it until November, December, but so we get to that point of the year and you've got some realized gains that investments that you sold during the course of the year, but you've got some fund that's down. You can just by selling that fund, you can offset that taxable income by recognizing that loss.
Okay.
So in essence, the investment's already down, but you've created taxable income by recognizing some gains. So by recognizing that loss, now we've offset the gain, and in essence created back to tax-free income just by recognizing the loss.
And then you can buy back in, but there's something called the wash sale.
30 days.
Okay.
So you got to wait 30 days before you repurchase the whatever it was that you just sold at a loss.
But let me go back because I'll use ExxonMobil, right? So correct me if I'm wrong, because I'll go back to kind of Derek's point.
Exxon or Mobil?
There we
go. Right? So client has ExxonMobil. It's down 90% that particular year. They can sell ExxonMobil, buy Chevron, still hang out in the oil space, and then 30 days later buy back into ExxonMobil. Is that how it works?
Right. As long as they're not buying Exxon. Mm-hmm. Chevron, basically the same company, but by purchasing that with the funds that you just sold Exxon, you're avoiding the wash sale rules.
Yep.
Yeah. So
and that loss can be used for deductions and to offset future gains that you might want to pare down gains in a future year.
Well, that's what I was going to say, Derek. So then walk us through 2022. Like, so why 2022 was such a busy time for us is because of that. I mean, because we said like now is the time to take advantage of that because there's also a carryover, right? Can, so even if let's say you harvest losses and okay, now you have 20 grand in losses, then what?
Yeah, I mean, conceivably, you could. So if you don't use the 20,000 in losses in that year, 17,000 of it's going to carry forward to 2023 in that example.
And you get a deduction of
and
3.
You get the deduction of 3. But typically we talk about harvesting when there's already gains, but there's possibility that you've also got you've got losses that you've realized that now you can maybe work into diversification by taking some of your gains from some of your other funds and offsetting losses that way as well.
Well, when I think, Derek, you had mentioned it too, because sometimes our clients are business owners and we'll say, look, when are you planning on selling, ABC business? And it's like, okay, well, if they're selling in 4 years, try to harvest as much losses because we know there's going to be a big gain in 4 years. Mm-hmm. Is that accurate?
Yeah. And I know Keith's not here with us today, but we've worked on that with a few different clients.
Yeah.
And it can be, sorry to interrupt, Eric. I mean, it can be a business, even if you're a business owner, but it can be a home. I mean, I did have a client that was he owned a number of different rental properties, and he knew the plan at some point in time was to sell not all of the properties, but one at a time.
He had some gains in there, right?
He had some gains just with all the depreciation on the basis, and so he said, okay, hey, let's build up a whole bunch of losses. Not that we want losses, but it goes back to Derek, what you were saying. I mean, like, there's always opportunities out there, right?
Yep.
So taking advantage of it, and then we were able to bank roughly about $50,000 worth of losses. He only sold the property last year, but he carried it over and offset. I mean, that's what's 20% or whatever. I mean, taxes lost on that amount of saved.
Massachusetts and all that.
It's
thousands of dollars. You know, and I think from the other thing too, we talked about dividend income. You know, one of our favorite clients, you referred to us. This woman's like a multimillionaire living out near your office, and she last summer she complained because she was too hot and she didn't have air conditioning. I'm like, put air conditioning in. She's it's too expensive. I'm like, you have more money than you'll ever need. But anyways, when we took her on years ago, she was getting a lot of dividend income, but it was a lot of taxable income. I mean, she's getting hundreds of thousands of dollars of dividends. So we switched some of it up to be some of it's qualified dividends, some of it's municipal bond income. So she gets a tax-free income on that portion. But it's important, like I said, you have a lot of people, their biggest asset is retirement assets. But for some of our clients, they have just as much, if not more, in after-tax dollars. Maybe they got stock options from their company. Maybe they have built up just a large portfolio of an inheritance or just savings on the side. And they have these huge after-tax, non-qualified portfolios. There's also planning around how those assets are positioned. Both, do I sell based on potential gains, and how are they invested in terms of dividends? So I'm not paying, if you want to grow your assets, you might not want to have high dividends because then you're paying gains along the way that you wouldn't have to if you own something that was a lower dividend. So the planning is, I don't want to say endless, but there's so much out there.
Yeah, but I was going to say, sorry, I didn't interrupt, Peter. I mean, it really is just because if I go back to just to build on the dividend income, right? Okay, municipal bonds, tax deferred annuities, whatever that may be. You have all these different strategies, right? Highly appreciated stocks. You have direct indexing and stock option overlay and all the different strategies there. Donor advised funds. I mean, it just goes on and on and on about all the different tools that we have in the toolbox. And that's why I really appreciate, Peter, our relationship, is because you help walk us through, okay, how does this work and what's the best way of using this tool on behalf of the client.
Yeah, that's awesome. I'm a little, as we close, I'm just a little nervous, Matt, what we did to him here. We embarrassed him. I might not go to your office for a little while. I'm afraid what's going to happen in that office. But
I think we're already scheduled to March
10th. We'll see you in a couple weeks.
Oh, jeez. All right. I'll be prepared. I'll have to sneak in the back. But no, it's you can tell, honestly, as much as we joke around, not many people that we refer business to walk into our office and get a standing ovation. So that speaks volumes of how well you've taken care of our clients and been a big part of our business as we've grown over the years. And so we appreciate both the insight today and all the valuable insight you've given us over the last decade plus.
Thank you.
Anything else you want to close, Matt?
No, that's it. Again, just thank you so much, Peter. Obviously, as Derek was saying, the standing ovation does not happen every day, so it should speak for itself.
Awesome. Thanks, Peter.
If I could add one thing.
Yes.
Just during at the end of the game last night, Nick Sirianni, just when they asked him what brought the Super Bowl, and he said it was the team.
Yes.
And that's the way I see this as well. That it's SHP and the team. One person can't do it.
I agree. No, it's we always say it internally when we sit with clients. It's like, listen, you might be seeing me or an advisor, but there's like 20 people that have touched your plan to get it to where it is today. So team effort is definitely the way we believe in, and you're a big part of that team. So thank you again, and we look forward to talking to you all soon. Everyone have a great day.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.